everyone. Thank you so much for being here and welcome to Columbia Business School. For those of you who don't know me, my name is Gracie Sarkisian and I lead the Career Management Center. The CMC partners with students throughout their career journey, providing advising, programming, and resources to support career exploration and long-term professional growth. It is a privilege to welcome you tonight to this special event held in conjunction with the Silfen Distinguished Leadership Series. At Columbia Business School, we are committed to preparing the next generation of business leaders. Today's session reflects that mission by providing students with a unique opportunity to learn directly from one of the financial industry's most accomplished leaders. We hope this conversation provides both personal and professional insights into leadership, navigating the challenges of running a global bank, and practical guidance for MBAs aspiring to leadership roles in banking and financial services. Before we begin, I want to acknowledge today's date. Today marks the 24th anniversary of the September 11 attacks, which deeply affected many in our community. Having lived just blocks from Wall Street at the time, this day holds personal significance for me. I invite us to take a moment of silence in remembrance of all those impacted. This evening, we're honored to host a conversation with C.S. Venkatakrishnan, known as Venkat, Chief Group Executive at Barclays Bank. Venkat joined Barclays in 2016 after 22 years at JP Morgan Chase, where he held senior leadership positions in asset management, investment banking, and risk. Appointed as CEO of Barclays in 2021, Venkat brings deep expertise in risk management and global markets. Venkat serves on the boards of the Bank Policy Institute, FCLT Global, the MIT CEO Advisory Board, and the Institute of International Finance. In 2024, he was named chair of the Financial Services Taskforce under the Sustainable Markets Initiative, leading cross-industry efforts toward the transition to net zero. Guiding the discussion today is Professor Harry Mamaysky, Professor of Professional Practice and Faculty Director of both the Program of Financial Studies and the MS Program in Financial Economics at Columbia Business School. He teaches capital markets, asset pricing, and data analytics, and directs Columbia's Chief Investment Officer Executive Education Program. Previously, he founded the Systemic Risk Group at Citigroup and served on the firm's Risk Executive Committee. We will take questions at the end of the session, so please keep those in mind as the conversation unfolds. It is an exceptional opportunity to hear from a leader who has navigated complex challenges at the highest levels of global finance and continues to shape the future of the industry. Please join me in giving a very warm welcome to C.S. Venkatakrishnan and Professor Harry Mamaysky. Welcome.
All right, great. Well, thank you so much for coming to join us on this lovely late summer day. We were just chatting up there a little bit about my background and your background.
It rhymes.
That's right. It does. It does indeed. So can you give us the kind of an overview? You did a PhD in operations research at MIT. From that to being now the CEO of one of the preeminent global investment banks. How did your career path take you here?
Yeah, I mean, as I was telling you, I entered into finance because I couldn't get a job elsewhere. It's absolutely true. I was trying to be a professor. I graduated with my PhD in '91. You were a few years after me at MIT. And I was looking for an academic job. I couldn't get one. I worked for a small while at a consulting firm on the West Coast. I didn't like it. And then I applied for jobs in finance. I got a job at JP Morgan, and I took it. JP Morgan then was number 15 bank. It's not the bank you see today. And it was in the asset management division. I began as a programmer, and I was writing code for valuing fixed income derivatives. You wrote code for valuing equity derivatives.
I did. Yep.
So then I started there in that asset management division in 1994. And then I spent about 14, 15 years in that division till 2009. In the fixed income area, I ran a research unit there, then I ran the portfolio management teams there. And at the time of the financial crisis, I was the chief investment officer of fixed income. My then boss went on to run the JP Morgan investment bank, and I moved over and I was running derivatives in the investment bank, structured derivatives. And one day I got a call to go into the risk department. I did not want to go into the risk department, but I had no choice, and I went to the risk department, and I helped out on a few things there for a few years. And then I got a call to become chief risk officer at Barclays. And I did that for a few years. That's now finishing almost 10 years in a few months. And then after about 5 years in that job, 4 years in that job, I got asked to run the markets division. And I did that job for a year, and I got a call to become CEO. So it's and what I will say is, of all the job changes I made, I don't think I asked for a single one. They all came to me. It's absolutely true. Absolutely true.
Well, that's a remarkable story. And it's remarkable that they came to you, because obviously you must have been doing an amazing job in each role.
Or they had no better alternative. So
one or the other. Once upon a time, being in risk was considered something people didn't want to do, as you yourself pointed out. But you were the chief risk officer at Barclays. So, I guess maybe talk a little bit about how the risk role has changed over the years, and also how did the skill set and the knowledge you acquired in the risk, part of the bank serve you now as the executive?
I mean, it's an amazing thing. You never know what is important later on in life, and you never know what is important not just later on in your life, but later on in the industry or the sector or whatever you do. So you would have thought in the financial crisis, many of you would have been much younger then, but you would have thought in the financial crisis, 2008, 9, 7, 8, even 9, that when the banks that did not do well, it was because of risk management failures especially at senior levels. And the banks that did well had very good leaders who understood the risks within the senior leadership. And Jamie Dimon is the most shining example of that. But yet in 2012, when I was being asked to move to risk, I was not smart enough to see the value of being in risk. Now, if you look across the banking industry, I can count at least 4 CEOs who've been chief risk officers of some shape or form. Me, BNY Mellon, Robin Vince, Christian Sewing at Deutsche Bank, Carsten Eggeris at Danske Bank, which is a smaller Danish bank, but he used to work for me. When I became chief risk officer, he was the first person to quit on me. But there are more. And what it does is that it teaches you, there are lots of people in banks who care about raising revenue for the next day, week, month, quarter. And risk is not about cutting losses, it is. But it is about the long-term profitability of the institution. How do you make money in the short term so that you don't accumulate a problem or a position or a type of risk or a behavior that sometimes later comes and hits you and costs you orders of magnitude more than the money you made. So what it teaches you in the end, I think, is how to preserve the long-term profitability of the bank. And you marry that with business roles where you do short-term profitability, and then you get a full picture of how to, hopefully run an institution well through a cycle.
Yeah, it's fast. It's amazing how the role has changed. I mean, yeah. I think you're completely right. Like after the global financial crisis, Goldman did well, and a lot of it is attributed to their risk management practices. And I think Wall Street embraced that ethos afterwards in a way they hadn't before. So I guess the next question I was interested to ask was, now that you've been CEO, what personal qualities do you feel are important Like, is it leadership? Is it giving a good speech? Is it listening to people? Like, what is it that actually allows one to succeed at this kind of level?
Look, in some of these questions, I can only answer based on myself and my experience, a little based on what I observe in others. You're at a great business school. You've learned enough statistics to know not to trust, a couple of data points. So take it with a pinch of salt when I say these things. Before I took the job, and I actually had a discussion about this within our bank a few weeks ago. Before I took the job, what I thought was important was technical skills, awareness of the environment, being able to understand the impact of technology, how to work with people, how to motivate teams. All of that is important. Don't get me wrong. All of that is important. What's equally important, which you build up through a career, is adaptability. If you work a long career in one place or many places, you'll have good projects and bad projects, good bosses and bad bosses, good years and bad years. And you have to see through that. Second is, part of adaptability is resilience, which is, things won't always go your way. Even if you're right, things don't go your way, right? So good decisions can still have bad outcomes. Hopefully you don't make bad decisions, but some of them can have good outcomes. And then you think you're smart, you're actually not. But you have to have the resilience to go through that. Equally important are integrity and values, because that is the one thing people see most about you. You keep reading the newspapers day after day, week after week, and you find somebody, some CEO, right? There was one 2 weeks ago in an important European consumer goods company who did something wrong. And you just can't be that person. It's not good for you. It's not good for the organization. It's not good, period. So it's those things, Harry. It's resilience, adaptability, values, integrity, and of course, working with people and having the long-term view. Because the other thing in a company is there are lots of people who worry about the next day, week, or month, or quarter. There are some people who worry about the year. There are not that many people who worry about 3 years and 5 years. And that's actually the job of the CEO.
As you progressed in your career, and you had to learn these lessons, right?
Sometimes the hard way.
The hard way.
Yes.
But was there an easy way? Did you have a mentor? Did you have someone you look up to who gave you advice on how to navigate this role that you now have?
Certainly not. Well, I actually have more mentors or people helping me today than I had people early on in the career. Early on in the career, you sort of, mimicry is important. You look at people and you see what the good habits are, and you try to follow them. Some people are good at speaking. Some people are good at managing their time. Some people are, good at just technically good. And so you try to learn that. You've got to learn to avoid the bad habits, right? Then, when you, like at this job, you get sort of two kinds of advice. Everybody in a company is willing to advise the CEO, right? Here's what you should do. Here's what you shouldn't do. This is bad. That is good. Listen to that person. Don't listen to that person. You put that aside. And what I find is other CEOs, it's actually even people who compete with each other, even other bank CEOs. Our institutions may be competing, our people may be competing, but the group of CEOs is a fairly actually mutually supportive group. So they've helped me, and professors. There are people who study leadership, there are people who study the environment, and I used to poo-poo leadership books, and now I think they're really good.
Well, that's good. But I'll mention.
So the books did not change. I changed.
I'll mention that to my colleagues who write those books. All right. So maybe to shift our focus a little bit, it feels like we're currently at a fraught time in history in many respects, right? We have, unfortunately, a shooting war in the middle of Europe. We now have this sort of bipolar world where China and the US are competing for global influence. At the same time, we have this generational technological shift going on with AI. There's a lot of things going on. Like as you from your perch, look at this world and think about what opportunities are there for your firm, for our society at large. Man, it's a very broad question, but like, what are the things you focus on as being really important?
Look, it's a very deep question, and I think I've fallen into the trap because by having said the CEO has to think 3 to 5 years, I can't duck the question because what you're talking about is a 3 to 5 year, much longer horizon. I think, first of all, at any point in time, we think that we are in the most complicated, most uncertain period. It really isn't that true. Anytime you go back, you'll find, if you were the CEO of a company in 1955, there was a different outlook. If you were in 1973 with the oil shock, it was a different world. In 1991 with the breakup of Europe and the Gulf War, it was a different world. So we have to keep that in mind. Sometimes we recognize the threats and opportunities, such as the general purpose technology of AI, and what's going on in the deglobalization of the world. But I think the important thing is to find out where you think your opportunities are and where you think your risks are. This is true as an individual. This is true as a company. So for a global bank, banking, like all politics, they say all politics are local, all banking is local. Banking begins because you're serving individuals, you're serving companies, small companies, big companies, and you're serving institutions. So where you operate, how you operate, which countries and worlds you operate in are very important. You had a big trend in banking from 1990 through to, say, 2020, of banks becoming bigger, more global, more retail all over, and then it started shrinking. It's coming the other way. So you've got to decide on your footprint, are you happy with your footprint? I'm happy to say Barclays sort of went through some of the pain of growing and shrinking earlier, so we're fine. The next thing is, how does the way in which you serve your customer change? And clearly, the biggest bank branch for any branch today is, I don't have my cell phone, but it is that cell phone, right? 95% of everything that you do, especially in the retail world, goes through that. And slowly in the institutional world, corporate treasurers move money this way. And people, electronic trading, as you know, has taken over the world. So how do you manage that, which brings both efficiency and risk, is a big question. And how does AI going to change that, is the next question. I don't think we have answers. I think we know these are the questions, and I think we're all trying to make things efficient in small ways, and then hopefully make things efficient in big ways. And then I think you didn't ask this question, but to individuals at your age, your career is going to be defined by, by how some of these technologies get used, how you help make them used, and how you help other companies whom you serve use them. In all of that, you can't let go of your basic values and the skill set of resilience and adaptability.
So let me follow up a little bit on the AI. So like, to me, you can think about AI as happening at multiple levels, right? So I can think of three, and let me ask you about each one in turn. So one is just the mundane day-to-day stuff. Like, how has AI changed, the mundane day-to-day tasks that you do at your bank? The second one is more like, what kind of investments are you making in AI, like firm-wide, to facilitate these tasks, and what are some of the big picture things? And I guess the third one is, how does it change the industry landscape overall, right? Like, it can, on the one hand, facilitate decentralization. On the other hand, it can cause a network effect where, the big grow bigger.
Yeah.
The tech firms that provide AI. So starting with the mundane, like, how do you guys use AI? How do you use it personally, or your employees use AI in day-to-day tasks that they weren't using a year or 2 years ago?
So, look, beginning with the mundane, we made the decision to make AI or Microsoft Copilot available through Microsoft Teams to all of our employees. So that's not cheap. And I knew it was not cheap when the Microsoft CEO used it in an earnings announcement. So I said, oh God, it must be a big contract. But it's actually a wonderful tool. And it allows people then to start this exploration. I can certainly tell you, and maybe I'm getting old, maybe my attention span is getting smaller and shorter, but if somebody sends me a long, complicated document, the first thing I do is send it through ChatGPT just to get the summary, because I can't read the whole thing. But more seriously, I certainly use it to go through both emails and outside documents to do some sort of basic analytical work sometimes, to follow up on, find patterns and things I've done. I see 10 documents on a subject, and I want to see what has changed in the way they're talking about something. I'll use it that way. I think others are. I think people who are in more processing functions are using it similarly to link documents, Then if you move up, having made it available, we then also basically had hundreds of hackathons around the company, asking people to take processes on which they worked and suggest improvements. And we funded a bunch of them. So that's happening. What that does is that it disseminates the technology, it disseminates the skill set. But ultimately, if you're going to do something big, then you have to make that a decision that has to be fully invested, fully funded, and which people do not get a choice. So if, for instance, you try to do it on customer service. So if you're in a bank, somebody calls about an account, they have questions on the phone, in the pre-AI days, somebody types it all in what's called a call report. Now you can have it recorded, and then you can get a draft report which the person corrects. Then anybody, if that customer calls back again, and another agent picks it up, they can read that report. Now they can use AI to go at that report and all previous reports and get a quick summary of what the customer has been talking to you about. Then the third thing is the customer may ask a question, which is a complex question. I've had a death in the family, the person had an account, this is the problem with the account, how do I get the money out? Right? And the customer service agent may have to go through, within the bank, 5 or 6 different web pages to get the answer. Now they can use AI to do that. So all of that increases productivity. And it's now being applied to thousands of people. It makes mistakes, but you've got to get people to use it in spite of the mistakes it makes, to correct them, and then forces you to stitch together your data and your platforms. That is the hard stuff. And whoever does that best, most across their companies, and makes it persistent, will ultimately get the productivity benefits. By the way, people talk about job losses associated with it. There will certainly be job losses. There will be some job shifts. But I think over time, and I'm not talking decades, I'm talking a few years, I think what you can see is the productivity benefit in one area will give opportunity to people to have better jobs as well.
That's interesting. So you gave us an example, like in the consumer-facing part of your business. Do you see that that's kind of the early adoption part of the firm, or are like people in capital markets, investment banking adopting it in different ways as well?
Yeah, certainly in the investment bank, we're looking at versions by which people can gather company information and do deal memos quickly. We also have almost out credit reviews. So, you lend money to a company every quarter, you get earnings estimates from them, or even if it's a private company, you get cash flows. You can process it quickly. You get news. You surf the web for the news about the company. So it gives you early warning signals if something going wrong. And then on the trading side, trading is more or less electronic these days. The days of somebody calling up and saying, buy me 10,000 shares of IBM is gone. It's all electronic. And in the bond market, it's 70-80% electronic. So we are deploying bots that basically get an input, an incoming request for a price, and then go scan the market, get a price either from ourselves or somebody else, and then put it back to the customer and match it. And then at the end, do the entire settlement.
Wow, that's impressive. So as you're doing this, and JP Morgan is doing this, and everyone is doing this,
Yeah.
how do you see the industry evolving? And I guess what I'm thinking about is technology has allowed, in some way, disintermediation of the traditional finance roles, right, through blockchain or small businesses being able to start and having access to cloud-based infrastructure. But then on the other side, we also see examples of the big getting bigger with AI. So from the financial industry landscape, how do you think it facilitates the disintermediation or actually centralization of roles over the next several years or decades?
Technology generally has facilitated disintermediation in finance. So what does a bank do? At its heart, it only does three things. It stores your money. You go, give it some money, you have it in your bank account. It moves your money. Take your money from Harry and pay it to Gracie. And then it lends you money. You want to buy a house, you want to finance a portfolio of stocks, bonds, whatever complicated thing, you borrow from the bank. I have a colleague here who's an investment banker. At the end of the day, when he constructs a deal for a client of ours, an M&A transaction and so on, it is some combination of all three. We will lend them money to do the transaction. We will move money between entities to help them do it. We will store money, what comes out of it. Those are the three things. 30 years ago, a bank did everything. Today, all of you guys are using Venmo to move money. You're using it to store a little money. PayPal might even offer you small loans, I think. So people are eating into all of that, which is disintermediation. And that's happening through technology. The AI will make all of that easier. But the fundamental thing that it cannot do, which is the other part, is it cannot be an ultimate substitute for the customer experience. Yes, you don't walk into the branch that much, but you will walk into the branch when something is complicated and you need help, right? You will call my colleague here when you want to do a big purchase of a company or a sale of a company. You're not going to trust that. And I think if I look back at my own career, one of the easy traps to fall into banking and in banking and finance is to think it's all about math and numbers and data, and not to forget that it's to forget that it is somebody's money, it is somebody's life, it's somebody's financial decision, an individual or corporation at the end of that. If we lose that through this technology, it's a mistake.
I think that's absolutely true. So you've now we've segued a little bit to the downsides of AI, like the loss of human contact. There's other downsides, and I feel like as a society, we're discovering more and more downsides as time passes. I mean, one obvious downside is hallucinations. There's been recent news flow about AI giving people with suicidal tendencies really bad advice. You have examples of models that are seeming to trick their trainers into thinking they're analyzing data in one way, but they're actually doing it in another way. There's obviously very important privacy issues.
Yeah.
So how do you think about the risk side of AI, and how do you mitigate those risks?
So it's one of the most important things. And from the early days, we've had a strong team of what we would call model governance, something you know well, look at the AI usage, which even though they're not mathematical models in that technical sense, to try to identify when this might happen. And more to identify not just when it might happen, but when the consequence of it's going wrong is really serious. Right? Because there might be some things where that hallucination does not matter as much. And there would be other things when you're trying to give somebody very personal advice where it might matter. So I think we are learning as we do these things. And I think there's a real race between those who are too worried and trying to stop implementation and those who are too aggressive and don't worry about the consequences. We will make mistakes. I think all institutions will make mistakes. But I think at this stage, it is important to have governance, especially on things that are direct to a customer, right? If a bot quotes a slightly wrong price, and the bank loses a little money, it may be okay. If it quotes a high price and somebody doesn't trade, it may be okay. If you give a customer wrong advice, maybe less okay.
So customers and advice actually is a nice lead into the next topic. We are seeing another big shift in the financial world, which is public versus private markets.
Yeah.
And famously, the number of publicly listed companies in the U.S. is shrinking. Many really big companies want to stay private. Right now, with the new OBBBA legislation, we're trying to make it easier for 401k accounts to access private assets. At the same time, we read that some university endowments, other institutional investors have investments in private assets they want to get rid of. So we're now facilitating, in effect, a transition of assets from institutional ownership to retail ownership where it hasn't yet been. So how do you think about that transition that seems to be starting to happen, and what are the upsides and risks involved with this transition?
Look, the definition of what is an asset class has been broadening. When you and I started in our careers, it was, stocks, bonds, real estate, maybe gold, some precious metals, commodities. Now it's including hedge funds, it's including private equity, it includes private credit. The other thing to know is that part of this increase in private credit is because banks themselves have been lending less directly to companies. If you go back, banks have had loans on their books for centuries. You would call those loans today private credit, but they were just loans on a bank's balance sheet. The Fed has a measure, it's called C&I loans, commercial and industrial loans. And if you look at the percentage of total commercial and industrial loans, it originated from banks in the United States. In the 1950s or 60s, it was close to 95-odd%. Today, it's probably around 65-odd%. And that decrease has been funded by mutual funds, high yield and investment grade bond funds, and increasingly private credit. What's happening when this comes into retail is that it will have a return which you hope is higher, but has not been tested through economic cycles like the stock market has. You can go and get 100 years of data on US equities, more in certain countries. You can get 70 years of data on bonds, but you can't get that for private credit or even private equity. The second thing is, so you don't know how well it will trade in different environments. Second, it will be less liquid. So I think, given all of that, and given the importance to customers to understand what kind of risk they're taking, the amount of disclosure that has to go with this and education that has to go with these changes is immense. And I think it may be one thing to allow it, but whoever offers it on their platforms to retail customers, I think it is incumbent upon them to have strong disclosure, good education in a simple way that people can understand. Right? And not doing that, would be harmful, I think.
It's a brave new world, I think. My sense is a lot of, as you mentioned, retail investors don't understand the impact of illiquidity. They think of it in the abstract terms, and then they invest a lot and need the money and can't get it. And I think education is probably crucial.
And to those of you, if you end up in the industry, whenever you do these things, always ask the question, would I want my mother to own this? Would I want my grandmother to own this? Or do they understand the risks? And if the answer is no, then you should do a better job of disclosure or education, or you shouldn't do it.
I think that's very good advice. So one of the things we've done at Columbia University recently that's been sort of a big deal for us is we have a new climate school here, which we've invested a lot of resources into. I was looking up a few statistics. Like global temperatures are about 1.3 degrees Celsius higher than they have been, like last year, than they have been in this century. I think the amount of carbon dioxide in the atmosphere is the highest it's been in 800,000 years. I'm not sure how they come up with that number, but that seems to be the science. What role do you think finance plays in this climate,
Yeah.
problem that our society seems to be having.
Yeah. I've got to tell you that I had a complete conversion on this. The first time I even was part of a discussion about this, I was Chief Risk Officer at Barclays 2017 or 18 with some regulators in London. And they said, we think the banks have to do more positive things to help fund, help fund sustainable companies and sustainable technologies. And I thought to myself, why should we do this? The private sector will take care of it. But of course, if you come back to what you learn in economics, the basic thing is it's an externality, right? Climate change is an externality. It is the result of things that people produce, people consume, and that pollution is emitted by you, and the cost of it is shared by 7 billion people in this world. And so an efficient market which prices that could potentially make you reduce your emissions, but that's a very hard market to come by. And so there is a role for people to play and for entities and banks to play in helping finance the companies that can make a difference. Some of these companies will finance themselves. I mean, Tesla financed itself, right, through its entire journey, and arguably has had a strong impact, not themselves and through all the other electric vehicle companies that have been spawned in reducing automobile pollution. But there are some things which banks can do to help shift that technology and to help promote newer technology, whether it's solar, wind, carbon capture. I'm part of consortiums that help do that, and government institutes and so on that do that. Part of the problem is that this has become too politicized.
As many other things.
Yeah. And I think you have to separate away your belief in good or bad, whether you think global warming is happening or not. I think the evidence is, as you've said, it is. And there is a role that the large institutions have to play in matching funds to technology. Hopefully, the private market does most of the work, and you can help it a little. And there's enough in the private market that banks can actually do, mostly private deals and actually find them financially remunerative. But it's as wrong to say, I won't do it because I don't believe in it, as it is to say, I must do this even if it's uneconomical because it's a duty. The answer is somewhere in between.
It's a hard one to figure out, especially because, the science is hard, the politics are hard. It's a very hard issue.
Well, and for some of these companies, not everybody can be like Tesla, where they can get the quantity of capital, have a CEO with the vision and the drive to make it work over 10 years, and then bring it to market and have it commercially succeed.
Yeah.
Right. And not, it's just life. So you've got to help them along that.
All right. So I think we want to spend most of the rest of our time with audience Q&A, but I have one more question before we turn it over to the audience. So we have a lot of students in the room. There are three types, I think. We have MBA students, obviously. We also have master students in technical fields, and probably a few PhD students. They're all interested in a career in finance, I'm guessing. What advice would you give a young person to succeed in this industry?
Well, first of all, I would say, having spent 30-something years in this industry, it is, and I think 30 years from now will still be, a fascinating industry that allows you to use a range of skills, human skills, technical skills, whether it's mathematical or computational, analytical skills, and because of what you do and its connection to the real world, a real connection to the global economy, to what are new technologies, and so on. It's also a very rich and diverse field. You can do anything from, helping customers manage their checking accounts, get foreign exchange, all the way through funky VC and private equity and hedge funds, and electronic trading. So there's this range of things. And obviously, it employs millions of people. The important thing is to ask yourself why you like it start developing the skill set that you need, but always try to be broader in your skill set than what you immediately need. Because you need to be adaptable, skills will be changing. And I think because you're handling people's money, being trustworthy and being a good steward of a person's money is really, really important. Just as you can't be a doctor without being compassionate, right? I mean, there may be uncompassionate doctors, I haven't met them, but you know, part of being a doctor is being compassionate because you're healing. Part of being in finance is you've got to be a steward of somebody's well-being, of their financial well-being. You know, doctors take care of your physical well-being or mental well-being. And by the way, your financial well-being affects physical well-being and mental well-being. And you have to have that sense of stewardship. And that's the first question you've got to ask yourself, and you've got to make sure you hold on to it and then be and learn.
I think that's great advice. Okay, so maybe now we
Sure.
can open it up to questions from the audience.
Hi, thanks very much for a lot of insights that we got today. One particular question on one of the points that you mentioned, that the private credit market, the CNI loans that the industry lost from 95% and it's currently around 65%. That means the private credit players have actually encroached upon the space that the banks were in. Now, of course, they might have increased the pie as well, but they're able to sustain almost a third of the market share that the banks used to dominate. At 65%, they're still dominating, but then definitely there's a big substantial portion taken up by the private credit. So my question to that is that what were the reasons how that private credit industry came about beating the commercial banks or the lending industry in that sense? And what is it, the competitive advantages that they had, which they are able to sustain and the banks are not able to take the market share back?
It's a good question. So first of all, not that loss of 30-odd% is not just banks, it's actually mutual funds as well. Because when you have a bond mutual fund, companies have issued bonds. Banks can help them issue bonds, but the ultimate holder of the bonds are pension funds and individuals. So private credit is an increasing part, but it's not that 30%. I don't remember exactly how much of that 30% is private credit. But the two things have happened that have increased its applicability. One is capital rules after the financial crisis, which made it more burdensome for banks to do those kinds of originations. So if you way you want to think about it is capital is how much of your own equity you set aside to cover potential losses from any activity. So what you set aside to cover that kind of loan has increased since 2008. Second is regulators across the world have put more restrictions on the type of loan you can do, meaning the credit quality. So it's the lower credit quality that has gone into private credit. The higher credit quality has remained with banks. And there's obviously something at the edge. And then certain sectors which are lower credit quality because they have less proven cash flows, parts of technology, parts of healthcare, are the ones that have really gone into that. So that's what's happening. And so part of it is regulatory, and part of it is as it has grown, you know, it has gone concentrated into some sectors.
Hi, Venkat. My name is Mark Knapp. Thank you for doing this talk and having this chat with us. You mentioned the need to govern AI. Should we be governing the AI itself or the outcomes?
Well, it's very hard to govern the insides of the large language models unless you build them yourselves. And I think, you know, just from what goes on in the Valley, the number of companies that can actually build them really well is a few. So it's hard, they have to govern themselves. And I know if you talk to the big, or you read about the big tech players, they are building things to govern the source of that hallucination, the source of, and you know, it's a marketing advantage to them. You have to build the usage, you have to govern the usage. But it's no different from governing the usage of a statistical model years ago. So, you know, 30 years ago when people wanted to issue car loans, and one of the things they said is, I'm going to price the loans based on a bunch of factors about the customer. And one of the things that they used was zip code. Now, they thought they were using zip code to measure the wealth of the customer. But people realized afterwards that it was discriminatory because it was discriminating against zip codes which had more minority people, right? And so these are unforeseen consequences, and they get corrected. That obligation to manage the unforeseen consequences is on the person who's using the model to face the customer, which in our example is a bank.
Thank you so much. This was an honor. I'm curious, you talked a little bit about financial incentives for public good, right? So climate change coming up with regulators and public and private partnerships. I'm curious what financial incentives you are most interested in, most looking at for public good projects, climate change just being one aspect of it, but also widespread transportation and the space of profitability, right? So public good can also be incredibly profitable if you get in quickly enough.
So look, in the end, if you cannot get financing for a project at commercial rates, it's because something about that project is unproven, right? Either it's the technology that's unproven, often companies are unproven, and so on. And in the most common way of getting that financing has been through venture capital. Equally, even when you think about the large venture capital investments, ultimately they get a subsidy in terms of usage. So that usage can be, if you think of even something like SpaceX, right? I'm not saying it's getting a subsidy, but it's getting government contracts, which helps it move. So when you think about things like heat pumps, when you think about solar panels or even electric vehicle adoption, there have been government credits. And where banks can play a role is they can lend people money. But equally, if it is not on commercial terms, it's important, say, for the government to either give some relief on taxation, some relief on capital treatment for these loans. So that's the way it has to work. It's hard, it's complex, there are many of these, but there's some combination of a use of a technology that you want widespread, the role of somebody in lending money, and if it cannot be commercial, where is the subsidy coming from? Either a government or somebody else, right?
I was struck by you saying that the opportunities that you took sort of came to you rather than you pursuing them. But I'm sure those aren't the only opportunities that you got. And I wonder if, I'm curious to know, how did you make the decision that that was the right time to make these sort of moves? How did you make the decision that that was the right time to leave JP Morgan and go to Barclays? What frameworks did you have in making these moves?
So there are two things you're asking. One is, what's the road not taken? And then the second thing is, okay, you decided to take this road, or the road came to you, and I'll tell you 9 times out of 10, I didn't have a choice. Leaving JP Morgan, I had a choice. And why do you make that choice? So I think these are hard decisions. Generally, what I advise people, it's always easier to advise somebody than to advise yourself. But what I advise people is, if you're going to change something, unless it's your first job out of your MBA program or whatever, but even if it is your MBA program, you have 3 things. You have your skill set and what you do. You have the people you work with, and then you've got the institution, which can be different from the people you work with. Try to take risk on one of the 3, not 3 of the 3, and even 2 of the 3 if you're taking, it's hard. So when I left JP Morgan, I was actually going to work with people I knew in an area which I knew, which was risk. I was taking an institution risk. So one of the 3 I could take. If I took a different job in JP Morgan, often it was not the institution. Occasionally it was the skill set, because I was asked to do something different and not the people. So that's the way I would say it. Now, some people are more risk prone and they will take 2 of the 3. Some will take 3 of the 3 and they will say, I'm getting rewarded because some pay me. But the kind of thing I never did was as I said, when I joined JP Morgan, it was not the bank it is today. There were many times I got offered from other companies, I didn't go. And the second thing is I never went to a hedge fund. And because I personally valued the long term over what was the immediate short-term gain. But different people are different, right? So that's ultimately, it's a personal preference.
Thank you so much for coming. I loved really the part when you talked about values, particular having values and integrity along your career journey. And in Bank's 22 and 23 DI reports, you emphasized that making the bank more diverse, more equitable, and more inclusive was core to its strategy. And you personally signed those statements as CEO. Yet in April 2025, the bank scrapped gender and ethnicity representation targets in the US while keeping them elsewhere. How do you reconcile those earlier commitments in your strategy documents with the decision to drop measurable targets in the US?
So one thing is a value, which is important to a company. The second thing is how do you affect those values? And the third thing in affecting your values is always compliance with law. These are not easy decisions. These are not easy decisions. So I do believe that you have to have a workforce that is diverse in its fullest sense, not just people from all backgrounds, all races, all genders, orientations, but that you get the best talent and that you give them the best opportunity to succeed. So give them opportunities that they rise to the fullest potential, right? And that has to be blind. And the way you can, where targets come is allowing you to measure how well you're doing. But it's a simplistic measure, right? If something reaches a certain percentage, doesn't mean necessarily that it's good. It's, it's an indication. Meaning the percentage, maybe the percentage you set is too low. It could be higher, right? And then the second thing is, while doing some things without targets is harder, you can still try to hire people from all backgrounds. You can still encourage them in their career and give them opportunities. And you should still be able to, in your workforce, right, make it inclusive. So meaning the things I care about are the broadest talent pool, the fullest opportunity, and the ability to come to work without and be completely comfortable at work, right? And I'll give you an example. I was sitting in one of a session a few years ago, and they were talking about, gender representation, global representation from different countries. And I said, all that's important. It's also important that you should be comfortable in the clothes that you wear. My mother wore a sari her entire life, right? She would have found it uncomfortable to come and work in a company where she had to wear Western clothes. We should not require that of people, right? So I think there's a very broad sense of diversity. And we unfortunately or fortunately, we have to obey the laws where we are, and we do that. But these are difficult decisions. The company remains committed to its values. I cannot say that strongly enough.
All right, maybe we'll take one more, and then I think we're running low on time.
Thank you very much for your time. The Barclays Financial Services Conference has just concluded with focus on AI, regulatory developments, and industry shift increasingly to defense and even more tech. What are the three most surprising takeaways? In particular, with the areas of focus to enhance capital returns at Barclays, wealth tech, insurtech, fintech, or others?
Good question. I think for me in that financial services conference, which was Monday, Tuesday, Wednesday, one of the things that was interesting was what was not said. So not a lot, to me, we've been living in an environment where credit has performed well for 15 years. In other words, you've not had, after the financial crisis, really high numbers of defaults and delinquencies among companies. The economy has been doing well, interest rates have been low and stable, employment has been strong, right? And there's been a lot of growth. And for all of us, banks, we are linked to the economy. And so our revenues, usually, it's a very simple, a bank's revenue statement at the end is very simple. You make some money, you have operating costs, and you have credit losses. Credit losses are when people don't pay back the loans. That number, that credit loss number, has been very low and decreasing for a long time, generally decreasing. There was a slight, aberration during COVID. So the thing that people did not talk about was how much they're worried about that in the future, right? So maybe we all have reasons to be confident, but let's see.
All right, with that, thank you. So I think Gracie had a few words.
I want to thank you, Harry and Venkat, for such an engaging discussion and such valuable insights. I wish you were here for 2 more hours because I want to pick your brain and continue to learn from you, but thank you for being here. I also want to thank my colleague Vaju Manyan, who helped us bring Venkat here. Networking is a key component to building relationships, but also it means we get to bring great thought leaders like Venkat here. So
Can I say something? Thank you, first of all, for having me. Thank you to Columbia. You are a great institution of the city. We hire many people from Columbia. Many of you go on to very senior positions at Barclays. So I'm grateful to the institution. As I mentioned, for some years, I used to come and teach a class every now and then with a friend of ours.
I think he's here, actually.
Is he here?
I saw him working. Yeah, there he is.
There he is, back row. He used to be my statistics professor, actually, at MIT. So I'm scared when I see
So
him.
he did a good job.
Yeah. But I'm very grateful. Thank you.
Well, the Columbia community is strong, and we're happy to have you a part of it, and you're welcome back anytime. We will love to continue the conversation. Thank you all for being here, but you can join us in the Wang Alumni Suite. So if you just exit the auditorium right up the stairs, there are some light refreshments and an opportunity to meet some folks from Barclays. So we hope you'll join us there. Thank you for being here and have a wonderful night.